The broadcast is now starting. All attendees are in listen-only mode.
Good morning, everyone. Thank you for joining us for our CalTRUST Market Update and Total Return Investing webinar. My name is Laura Labianier, and I am the CalTRUST Administrator. If you have any questions during the presentation today, please type them in the GoToWebinar control panel questions box, and we'll answer them at the end of the presentation. Before we get started, I would like to provide a very brief update that the new CalTRUST Liquidity Fund is on track to launch by July 2nd. As we've previously explained, this new fund will be a GASB 79 compliant 2A7 lookalike fund that will provide a stable net asset value. On the CalTRUST website, there's a recording of our last webinar where we introduced this new fund. More information will be sent to all participants in June. On today's webinar, BlackRock will discuss the present state of fixed income markets and how it continues to impact the investment landscape. Tom, can you please mute your phone? Sorry. On today's webinar, BlackRock will discuss the present state of fixed income markets and how it continues to impact the investment landscape for short duration strategies. BlackRock will offer insights into the current portfolio positioning for the CalTRUST short and medium term funds and the factors contributing to the fund's performance and NAV changes. The team will also give a brief tutorial on the drivers behind total return investing. Today's webinar will be led by BlackRock's cash management team and our folks in both our New York and Philadelphia offices. So without further ado, I will pass the discussion over to Eric to kick off our webinar. Thank you.
Thank you very much, Laura. And on behalf of all of us at BlackRock, thank you for the opportunity to address the group today. I'd like to start with a market review, speak briefly about the economy, and then about our positioning in our government fund and the Temp fund, money market fund. So I will start here on the overview page and jump right into the labor market. So the 3-month average for non-farm payroll is trending above 200,000. It's 208,000. And as this is running ahead of the natural growth in the labor force, it's pushing unemployment lower. So the unemployment rate last month fell to 3.9%. That's actually the lowest rate in 18 years. What's been frustrating is the lack of wage inflation. So beyond a few select industries that are experiencing some very tight labor conditions, this hasn't really been felt. And it's important because wage inflation leads to aggregate demand. And at this point in the cycle, with the unemployment rate where it is, it should be higher. I'm going to jump over to, I'll stay on, I apologize here. I'll discuss inflation. On the inflation front, we've been undershooting inflation for the last decade. Although we've seen a pickup as of late, certainly in headline inflation with the jump in oil prices from $50 a barrel to $80 over the last year, but also in core inflation. And this has brought us, importantly, to close to the Fed's 2% inflation target, depending on what measure you're looking at. Manufacturing and transportation pricing pressures have been increasing. And now there's a debate amongst policymakers whether or not we'll comfortably be able to sustain that 2% target, and if so, how long it would be appropriate to allow prices to persist above this target. The takeaway here is that inflation is trending higher, but it's not likely to pop, and this is good because it provides the Fed flexibility, and the Fed is likely comfortable letting inflation move higher than their 2% target, at least for a period of time. And this is timely because we've just received yesterday the minutes from the May FOMC meeting. So we've got some more insight into the way different policymakers are thinking. When it comes to the economy, growth expectations, they're not through the roof. In fact, they're only a 0.5 percentage point higher today than they were in 2010. But if we make it to next summer with positive economic growth, it'll be the longest economic expansion in U.S. history, and that'll be 10 years. part of the reason it's not going gangbusters and it's growing around 2% is that we do still have a slow productivity growth, and that's been a bit of a conundrum. When we look at tax reform and the effect it's having, it is leading to a pickup in CapEx, capital expenditures. In fact, capital expenditures for S&P 500 firms were up 25% in Q1. And this is acting as a major support mechanism for the U.S. economy, including creating momentum in job growth. As of late, we've seen dollar strength and the potential, albeit slim, but the potential for trade wars, which would cause a drag on growth. But nevertheless, we expect growth to trend along at or around 2%. And then when we come to the Fed, as I said, we got minutes yesterday from the May meeting. We here expect the Fed to continue on their path of gradual tightening as we move closer to a neutral rate, which is basically the rate which is neither expansionary or contractionary. The Fed hiked rates in March, as was expected, and we expect, as does the market, another 25 basis point hike in June. And then one additional hike the remainder of the year, although there's been discussion around quarterly rate hikes, and so this would mean a hike in June, September, and December. We're not fully convinced this is going to play out. If you look at the futures market, it's about 30% priced out. That is a fourth rate hike, so it would be likely a December rate hike. We're more of the opinion that this is consistent with the message that the Fed has delivered in their minutes and otherwise, that they're comfortable allowing the economy to run hot, despite the fact that they've effectively hit their dual mandate of maximum employment, with unemployment at 3.9% and inflation at or around 2%. Moving over to the portfolios, in both Fed Fund and Temp Fund, there we go. Yeah, I'm going to move over to Fed Fund here. In Fed Fund and Temp Fund, one of the biggest drivers affecting positioning in recent weeks has been the large uptick in Treasury bill supply, which after the resuspension of the debt ceiling in early February led the U.S. Treasury to increase the outstanding supply of bills some 20% or over $300 billion. This in part helped push overnight funding rates higher, which had a knock-on effect not only in the bill market, but in the short credit market. As there's a captive supply, a captive, somewhat static supply of investable dollars at any given time. And until rates adjust for a big increase in supply, or let's say a pullback in demand like we saw with multinationals after the Tax Act in late December, where they effectively pulled back on their investment of cash, then the market has to recalibrate. And this to us in both the Temp Fund and Fed Fund was an opportunity. So it was an opportunity for us in, move over to Temp Fund on the credit side to effectively earn a spread of about 50 to 60 basis points over overnight levels by just sitting about 3 months out the curve. This spread is typically under 20 basis points. So we were effectively able to, for what was effectively the same amount of risk, earn multiples of what we typically are able to earn. So as a result, post-March FOMC, where we, as I mentioned, we saw the Fed hike rates, we added risk, bringing our WAM or interest rate duration out to 29 days, so close to 30 days, and our spread duration or weighted average life to 70 days. In Fed Fund, we, which is our CNAV government fund, we maintain WAM and WAL slightly longer in the 35-day range for WAM and 89-day range for WAL. In March and early April, we moved duration higher. As I mentioned, as out the curve, we felt compensated for given our projected path for future rate moves by the Fed. So with that, I'll stop and pass it over to Tom.
Sure, thanks, Eric. If we can turn to slide 10, and just thought I'd spend a little bit of time talking about the two funds and the composition and what we've done over the last month or couple months. So on this slide, we're looking at the short-term bond fund and the composition as it continues to be very high quality overall, with a good majority of the portfolio in high quality single A or better assets. As you can see in the pie chart on the left, good to half of the portfolio is actually single A or better. In corporate credit. A couple of things I'd like to point out that we've done and changed over the last month. Actually, you see on the upper right-hand side, the Treasury exposures has been decreased from 22% to 18%. There's, on our last call, we talked a little bit about some of the dislocations that occurred in some short-term rates, whether it be T-bill rates or LIBOR rates, and that really allowed us an opportunity to make investments in commercial paper and CDs during the last 6 or so weeks. So you see an increase from 26% to 32% in the month of April by going out and purchasing CDs from many banks, U.S. banks, and really getting an opportunity to increase the overall yield in the portfolio. In addition, on the bottom left, you see we've been very conservative overall with the duration of the short-term benchmark, looking to continue to preserve the NAV, the principal and NAV on a month-over-month change, and so we're able to do that by keeping the overall duration around just a little bit greater than 0.3 years. And really where we're getting the additional yield in the portfolio is through those CD or corporate bond investments. If we turn to slide 11, just a little bit more detail. And bottom left, I'd like to point out, again, the objective of the short-term fund is really to keep this NAV very stable and have month-over-month positive returns in the portfolio. And the way that we do that is making the investments in very short duration instruments or instruments that have floating rate coupons but slightly longer maturities. And you see the breakdown of overall weighted average life of the securities of being around 80% of the securities with less than 1 year, and then the duration about 96% of the portfolio really with assets shorter than 1 year. So very small exposure to anything greater than 1 year, and that really helps to minimize any NAV deterioration from rising interest rates overall. Bottom right, another way to look at overall risk differentials or changes over time is to think about how the spread risk has moved month over month in each individual sectors. And this will show that actually, even though we made an increase in overall exposures, you see again, cash is what we call CP and CDs. So cash is the one that's increased the most, similar to the chart on the previous page, where we've kind of made modest increases in overall spread risk into the portfolio by adding a little bit more yield. Where we get a little bit of additional yield is moving a little bit out the curve. You see kind of our duration positioning on the upper chart, where we've been slightly underweight that 1 year part of the curve and a little bit more exposure to twos. That's more of a functionality, just some unique opportunities that exist in the corporate bond market to kind of buy some 2 and 3 year assets to put into this portfolio, but it's relatively small and have minimal, if any, effect on the overall NAV of the portfolio. So overall, and I'll talk a little bit later just about the return of the fund and NAV. I just want to touch on the medium-term fund on slide 12. So similar to the short-term fund, very high quality, everything's A or greater, with a large component of the portfolio in AAA and government securities, shown on the upper left. In this portfolio, I would say we we didn't take advantage of the CP and CD market because those assets tend to be a little bit shorter than what we look to invest in the medium-term fund. And what we've actually done in this portfolio is increase some of our taxable muni exposure and treasury exposure, and reduce some of our higher quality supranationals or securities that are trading relatively rich in the market. So modest overall change from an allocation perspective. The biggest shift that we've done in this portfolio can be seen on the graph on the bottom of left of slide 12 here. The blue line was the duration of the fund, and the green line is the duration of the benchmark that we managed to. So last time we talked, last couple of times really, is talked about that the market wasn't pricing correctly the amount of hikes built into the curve. Therefore, 2-year yields in particular were underpriced in our opinion, and that means that we wanted to be underweight that part of the curve, or I say shorter duration. And so when this blue line is on the bottom below the green line, it means that we will generate additional returns relative to the benchmark when interest rates rise, and if interest rates fall, we will underperform that benchmark. And so we've maintained this bias to being shorter duration overall for the last 9 to 10 months in the portfolio, just until the last couple of weeks, I would say, is when the market 2-year note got above 2.5%. Market started to price in a third hike for the remainder of the year, and we felt that that was too aggressive by the market. So we've since covered all the duration and maintaining a duration much closer to that of the benchmark. Still relatively short, and still overall should protect overall principal from a modest rise in interest rates, but we think now's the time to get much closer to the overall benchmark. You see we're within 9 basis points and expect actually to be even closer to 0 relatively soon. Slide 13. Again, just to look at how the curve is positioning. Where we've added some of the overall duration, again, is in the 3-year part of the curve. The 3-year part of the curve looks a little bit more attractive relative to the 1 and 2-year part of the curve, to add a little bit more overall duration to the portfolio. We've done that. On the bottom left, seen a better example of the distribution of the weighted average lives and overall durations for the portfolio. And again, the medium-term fund, unlike the short-term fund, uses a little bit more of the yield curve, so I see a better balance between the 1 and 2 year and the 2 and 3 year part of the curves, and again, to add a little bit more overall duration to the portfolio and a different mix of income and yield to the portfolio itself. Next, I wanted to turn a little bit to talk a little bit more about the NAV volatility and the overall performance of the two funds. And slide 14 here shows really a history of the NAV of the two funds really since existence. And the blue line you see relatively stable, with the exception of that period in time in 2008 through that credit crisis that we had. Since 2008, the market's recovered. The NAV overall for this fund has been extremely stable. That is by design. Since we've been managing the portfolio, you have seen that interest rates have continued to rise, and so there's been this slight modest deterioration. If you look at the blue line really closely, the NAV has dropped ever so slightly, but that decline in NAV is just a part of the overall story. So while there's a price loss month over month, the income that we are receiving from the portfolio yielding, from the overall portfolio yields, it's outweighing that NAV decline. So if you actually take a look at slide 15, and if we look at the short-term fund's performance, over the last 6 months, where that NAV chart shows a slight modest decline, that short-term fund is still up 75 basis points, and the 1-year number is 1.34%. So even though your NAV has slightly come down, and so when you look at it, if I bought it at a 10.05 and now it's at 10.02, you've generated more income from the coupons in the portfolio, and so your overall absolute return is still positive. And when we think about the performance of the short-term fund versus the two liquidity funds, over a longer period of time, the short-term fund should produce a positive a return that's slightly better than the liquidity funds, and you see that kind of on a 3-year and 5-year basis. and 10-year basis. If you think about what's happened over the last 1 year since the Fed has started to raise rates, and the yield curve, the differential in yield between overnight rates and two-year rates has become much flatter, and so the yield advantage of the short-term fund relative to the liquidity fund has continued to decline over time, and that's why now the 1-year returns are much closer to one another, where the short-term fund is generating just a modest return over the other funds, and even on the 6 months, just a few basis points over the Temp fund. And actually, in the month of April, Temp fund actually produced a slightly more positive return by 1 basis point than the short-term fund. I think that's more of a short-term technical, and that may last for a few more months as these yield curves remain stable, or as interest rates yield curves remain flat, or as interest rates kind of continue to rise a little bit more modestly. You can still expect to see month-over-month positive returns in these portfolios, even with a declining NAV. But they may at sometimes, have a month in which they produce a slightly lower return than their cash alternatives. If you look at actually even longer maturity and longer duration fixed income funds, they are actually negative on the month of April, whereas these funds are still producing positive returns because you are generating a lot of income now that short-term rates have risen. So you've gotten this modest deterioration in NAV, but we're making up for that by having more income in the portfolios, and that overcomes kind of the decline. We can go back to slide 14 again, just to look at the NAV volatility of the medium-term fund, which is the green line. Again, it's more volatile. It's got a longer duration expected to be, and the idea is over a longer period of time, it's supposed to produce, or it should produce, a better return than the short-term fund or the liquidity funds. And you can see a couple of periods of time where the fund has had a drawdown because of a rising rate environment. Early 2000s, 03, 04, significant decline, again, as the rising interest rates bounced back. Then you had the 2008 crisis, where spreads widened dramatically and NAVs declined dramatically. Then the healing process through late 2000s into early 2010 and 11. And then up and down a little bit, but pretty stable. And then over the last 2 years, as the Fed's been hiking rates, and the 2-year note has gone from south of 50 basis points to north of 2.5%, you've seen this continued erosion of the net asset value. But if you look on slide 15, again, the 1-year return for the medium-term fund, again, pretty significant decline in overall NAV, but yet it's still producing this positive absolute return, and a return that's still greater than the other 3 products in the mix of investment choices. And over a longer horizon, the fund has continued to produce more positive returns and more returns relative to the shorter maturity or the stable NAV type products. Same thing has happened with the medium-term fund in the real near term, where in the last month, if interest rates rise a little bit too much, its absolute positive return will continue to be kind of eroded a bit, and potentially could underperform some of these short-term funds. So, bottom line, when thinking about the overall investment into short-term and medium-term, you should expect some NAV volatility, whether it be up or down in a rising rate environment. The NAV has to adjust to allow the yield on the current portfolio to match the yield in the market, and that's why you see a slight decline in the NAV. It doesn't mean that there's any problems with the securities in the portfolio. It just means that they're being repriced to the market. And with the high yield that it currently offers, you have the protection for rates to continue to rise and to still generate a positive return, as you can see what has exactly happened in the last 1 and 6 months, and even last year, with this continued rise in interest rates. So our dividend yield is going up. Returns are still positive. They just are not as positive as they would be if rates weren't rising as rapidly, because you're kind of eating in a little bit. So the overall total return of the funds should consist of both the income plus the principal, and sometimes the principal is negative, meaning that the sum of the two is a little bit less than the income in this particular example. With that, Eric, I'll turn back to you guys to talk a little bit about the difference between the GASB fund and the money fund.
Yeah, sure.
Hi, everyone. Just going to give a few points, talk about the comparison between Temp Fund and the CalTRUST GASB Fund. First off, the Temp Fund is currently a floating NAV portfolio, meaning your NAV is market-based. So as prices change, the net asset value per share of the fund changes as well. The CalTRUST GASB portfolio will be a constant NAV fund, so it will trade on a $1 basis or a constant NAV. Turning away from that for a moment, while there are several significant similarities between GASB and 2A7, the California Code does contain some significant differences. There's specific limitations with regard to overall allocation to security types. For instance, commercial paper, certificates of deposit, and corporate notes are more constrained under the California Code than they are under 2A7. There's also some constraints with regard to the types of commercial paper and maturities that can be purchased in the portfolio. Finally, nearly all the securities that are going to be purchased into the portfolio must be issued by U.S. companies or branches of foreign banks. This again differs from Temp Fund, and we expect this to present a modest drag on the yield of the portfolio. Countering that is the lower expense ratio of this portfolio when compared to Temp Fund. So on a anticipated basis, we expect the yield on this portfolio to fall somewhere between the government portfolio, Fed Fund, and the current 2A7 fund, Temp Fund. Any questions?
Kyle, did you want to open up to questions to the audience?
Yeah, I'll do that now. We have if you want, you can raise your hand and I'll unmute you. But there's a couple questions that came in through the chat, or you can also type your questions in online. The first was, what's the biggest concern that portfolio managers currently have for the various investment vehicles for CalTRUST?
From the medium-term and the short-term perspective, obviously the biggest concerns that we continue to have is this rising rate environment that we're in, and make sure that people do understand the issues with regards to a slightly declining NAV over time. I think that my biggest concern from an investment perspective is we do believe that the Fed continues on its slow trajectory, and one hike per quarter, if that much over the next couple of quarters, can the economy heat up a little more than where it's currently trending at 2%, leading to a faster hiking cycle, as I would say is a risk to the portfolios in general, which would mean that NAVs could decline even in a little bit more. But I think that's a low probability event, but that's the biggest risk to the overall portfolios in general, especially the medium-term fund.
Okay, and then the next question we have, and you slightly answered it there, but it's also, do we foresee greater principal loss in the medium-term fund, which you answered, but then also the short-term fund, given the expected rate increases this year?
I still believe the market's currently pricing in a little more than 2 hikes for the rest of the year. They've got 3 meetings. It had been at 2.5, taking a little bit out since the Fed minutes were released. But I believe that the short-term fund will adjust relatively quickly to any increases in the rates and continues to produce these absolute positive returns month over month. And I do think that the market's, for the most part, priced for the hikes, the potential hikes already. So the 2-year note in particular at 2.5% today, plus or minus, is fairly priced, and so we should see less erosion already, since it's already priced in.
Okay, thank you. And then we have a question from one of the participants online. Do you see the yield closer to the Gov or the Temp fund?
Well, taking a look at the portfolio and the opportunity set that presents itself for this portfolio, the likely scenario is that it would be pretty close to the middle of the two. Currently, I think there's a 30 basis point spread, or give or take, between the Temp fund and Fed fund on a gross basis. We can foresee a scenario where about 15 basis points separates the government portfolio from this portfolio, and then this portfolio to Temp fund.
Okay, perfect. And then I'll give it a couple more, but also thank you to our team at BlackRock for the informational session. Again, we'll open it up for a couple more questions if you have any, or if you want to raise your hand and ask our team over the phone. I'll unmute you as well.
Kyle, I would just add too that in the current environment with the Fed hiking and the yield curve flattening, the yield differential on all the product offerings has definitely become tighter. And that's just a function of where we are in the interest rate cycle and where the overall yield curves are. It doesn't tend to last for a long period of time, but it is something that is unique in this environment where the yield differentials on all the products have definitely come closer to one another.
And then we have another question. Without knowing the participants' cash flows, how do you keep a stable NAV?
Since there are multiple participants, is this for the short-term fund or just in general?
I would guess it's probably for Fed or the new liquidity fund.
Okay.
Well, the new liquidity portfolio, the stability of.
Yeah, sorry, really quick. It's for the new liquidity fund.
Sure.
Okay. For the new liquidity fund, the stability of the NAV per share, there's going to be a shadow. Mm-hmm. So there's going to be a shadow NAV per share calculated by the administrator. Transactions will take place at the constant NAV value, but the driver behind the stability in the shadow NAV, and I'll call it that, is based upon the relatively short weighted average maturity, the weighted average life, as well as the high credit standards that we'll have for this portfolio. So from the basis of 2A7 and 2A7 like portfolios, the general construct is so that the portfolio has minimal volatility.
Got it. Perfect. Currently, there are no other questions, so this will conclude our webinar today. I'd like to thank everyone for attending and thank the team at BlackRock for presenting. This webinar has been recorded and will be available on our website this week. If you have any follow-up questions, please do not hesitate to contact us. Additionally, I just want to note that the CalTRUST liquidity fund that we've mentioned here will be launching July 1. And we'll be sending out more information on that in the upcoming newsletters. Awesome. Thank you all for attending, and please reach out to us if you have any more questions.
Thank you. Great. Thank you.
Thank you very much, everyone.